Hi all and welcome to this video where I'm going to show you the best 3 ways to earn a passive income from options trading. Hopefully after watching it you will be able to understand which way is best for you, what rentability can you expect from your trading, how to plan your trade, and how to recognize the risks involved. If you are totally new to options, you can go to my Basics for Options Trading video where I discuss all the basic terminology you need to understand this video. Please remember that this is an educational video, I am not your financial advisor and this is not financial advice. This is More Than Value, your channel where we discuss about personal finance, self-development and much more. I welcome any video recommendation, leave me a comment and subscribe if you like the content. So let's get right to it. When you are building your way towards financial independence, you need to include a stream of income from capital gains. And this can be day trading in the stock market, dividends, or income from options. I personally like and incorporate in my trading income from options from the strategies that I will show you now. I find them easy to understand, easy to implement, and not very time consuming. So it is something that I am able to do and keep doing for the rest of my life. A notice of warning before beginning. When you are using options as an income strategy, you are basically acting as an insurance for someone else. This means that 90 or 95% of the time you are keeping the premiums that you receive and making a profit. But it will come the day where some big movement will happen in the market and you will need to respond for this insurance. And this is totally okay and considering the strategy. Just remember to never over leverage your positions so you have the capacity to respond. This means in practical terms to never use the credit available from the broker. Strategy number 1. Covered call. This is probably the simplest strategy for income from options. And there is the beauty of the strategy is simple. It is easy to understand and execute and it will not take you much time to plan your trade. The covered call strategy consists on writing up an out-of-the-money call contract, or selling a call, on shares that you already own. So if you have 100 shares of Facebook that you bought at 300, you sell one call contract of Facebook with strike price 330 and get a premium of say $15. Easy, right? Let's go over the details on how you can plan your trade. When to do a covered call? When you own shares of the company that you like, shares that you will not sell if the market drops. You want to keep them for the long run. You would, however, consider selling your shares in order to realize a profit if a sudden rise happens. Maximum reward. This will be the premium received plus how much you are earning from the difference of the purchase and the selling price of the shares. In our example, your maximum profit will be 15 plus 30 equals $45 per share or $4,500 for the whole contract. Maximum risk. You are not entering any additional risk compared with the case where you just own the shares. If something, you are lowering your break-even point. If you sell the covered call from our example, your break-even point goes from $300 to $285. You are, however, taking an opportunity cost, as it might happen that your stock rises to 3,000 and you are forced to sell for 330. Strike price and expiration date selection. There are many ways that you can apply the strategy depending on your view on the market. The first principle that you need to consider is the time decay of options. This will leave you with an optimal days to expiration below 90 days. Once you have selected an expiration date, you need to choose between at the money, out of the money, or in the money contracts. For call contracts, an at the money would be the $300 contract, out of the money would be anything above $300, and in the money would be anything below $300. Depending on your outlook for the stock, you can select any of these strategies. If you are neutral for the next 90 days, I recommend writing an at the money contract. This will allow you to realize the maximum possible premium while keeping a good chance that the option will not be exercised. If you are slightly bullish, then my recommendation is to write a 10% out of the money calls. This will make you improve your chances of not being exercised and compensate the lower premium by a higher profit from the raise of the price of the shares. Last, if you're bearish, go with a 5 to 10% in the money calls. This will allow you to collect the biggest premium upfront and lower your break-even point even further. As you see, the covered call strategy is a simple and safe way to earn an income from your portfolio. It does not require a lot of time to plan or execute, and once the trade is placed, you can basically forget about it until expiration date. Strategy number 2. Cash Secure Put. Also a very simple way to earn an income using options. In this case, you are basically waiting for the right moment to buy your favorite companies. The first step is to identify the companies you want to have in your portfolio and hold for the very long run. You would have the cash to buy the stock and you would sell an out-of-the-money put. If we look at our Facebook example, trading today at $300, instead of buying today 100 shares of Facebook, you can as well write a put option for Facebook at $270 90 days from now and get a premium of, say, $15. When the expiration date comes, if Facebook is trading at or below 270, your option would be exercised and you would be buying 100 shares of Facebook at an effective price of $270 minus the $15 from the premium, $255. You did manage to buy the shares of your favorite company at a 15% discount. If on the other hand, Facebook does not reach 270, you keep your premium and repeat the strategy. You have basically the option to get a dividend 3 or 4 times a year. Remember, this is a cash secure put, meaning that you have the cash you need to buy the shares you're writing a put for. You can get an additional rentability from the strategy if you invest this money in a short, fixed bond that guarantees you get the full of your principal back before expiration date. If we analyze a bit more the strategy, when to do a cash secure put? You have the cash, you love the company, and you want to buy the shares. Maximum reward. This would equal the premium received. Maximum risk. Your maximum loss will happen when the stock drops to 0. In this case, you can lose all your investment, except the premium, which you always keep. You can say that selling a cash secure put is as safer or equal as owning shares. Strike price and expiration date selection. Again, for the cash secure put, I can recommend to not write longer than 90 days to expiration. With that in mind, and depending on your outlook for the stock in the short term, you can follow these strategies. If you think the stock will raise in price, then I recommend selling at the money puts, as this will maximize the amount of premium received. If you are neutral on the stock, then go with a 10% out of money put. This will offer a reasonable balance between premium and probability to be exercised. If you are bearish in the short term, I recommend that you wait until the drop happens and then write at the money put. Thanks to the recent drop and increase in volatility, you will maximize the premium received. You see that the cash secure put is another safe and easy to implement strategy to increase your income and very similar to the covered call. If you are looking for a little bit more advanced strategy that will maximize your income, don't miss on our third strategy for income. Strategy number 3. Cash secure put plus beer call spread. Now is when things starts getting interesting. This is a strategy you will use under the same assumptions as with the cash secure put from strategy number 2. You still want to own the stock for the long run, even if they drop in price. The twist here is that we are adding a bear call spread so we can increase the amount of premium received without increasing our risk. A bear call spread consists in selling an out-of-the-money call and purchasing an even higher out-of-the-money call. Let me actually take now some real numbers for this example. At the time of making this video, Facebook is trading at $319.7 per share, and this is the table of calls and puts for expiration in 73 days. Let's select first the cash secure put, assuming we are neutral in the stock. We could sell a put 10% below the current trading price, say at $285, and collect a premium of $3.82. Just for clarity, I am taking here the midpoint between bid and ask quotes. Let's go now to the bear call spread, still with a neutral assumption regarding Facebook. Let's sell an out-of-the-money call 10% above the current market price. This would be, for example, the 350 call that we can sell for $6.1. Now we are in a risky situation because Facebook could rise significantly, so we need to deal with that. How do we do it? We buy the next call available at the same expiration date. So we sell the 350 call and then we buy the 355 call for $4.95. Let's see it all together. The net premium received was 3.82 from our put, plus 6.1 from the sale of the call, minus 4.95 from buying the protective call, for a total of $4.97. Note that we are now collecting $4.97 as a premium compared to $3.82 from only the cash secure put. This might seem small to you, but we are talking here about increasing our profitability by 30%. And this is only in 90 days. Imagine the effect that improving the profitability of your trades by 30% has in your results at the end of the year. But what happened with our risk? Let's see. If Facebook drops, we have improved our break-even point because we have received a larger premium compared to just the cash secure put. The new risk comes here when Facebook would go to 355 or above. In this case, you'd be losing $5 from the difference of strike prices of the calls minus $4.97 that you receive from the premium. So your maximum risk on the upside is just 3 cents. The risk-reward profile of this trade just got much better. So as you see, we were able to combine the simple call and put strategies into a superior one to improve our overall chances to make a profit. One final note from me, it does not really matter if you win or lose in one of your trades. These strategies will provide you with a long-term profitability if you are consistent and keep using them. If being consistent is a goal you're seeking, be sure to check out my video on how to achieve your goals. This is all from me now. Thanks for watching, leave a comment, leave a suggestion, and don't forget to subscribe. See you in the next video.